Right, getting back to a breaking news story that we've been tracking with Wall Street, seeing all stocks in the red. We have with us Anurag Singh, managing partner and Sid Capital. Anurag, thank you so much for joining us. Firstly, the impact of Trump's tariffs, that renewed threat of tariffs there, having its impact and its effect on the stock markets in the US.
Hi. Thanks for having me. Look, today's reaction is more a reflection of jobs report that came out a while back. And the employment situation indicated that the job market is weaker than earlier thought. And, even for the last month, the number of new job creation was expected to be around 100,000. It turned out to be 73,000. So about 27,000 jobs less were created in July. Aside of that, data was revised for May and June, and we lost about 120,000 jobs for May and 133,000 jobs for June. So which means there are good 270,000 jobs which were assumed to be created in May and June actually were much lesser, much weaker. So basically all this points to the direction that for the last 3 months, the employment market is much weaker. Unemployment level has ticked up to 4.2%, which means that Federal Reserve might have to look at unemployment problem more seriously than the inflation problem. Now, aside of that, inflation, of course, is not back to the target, which creates a double problem for Federal Reserve. So I think that's the reaction. If the economy gets weaker, then, of course, the markets will react adversely.
Right. Anurag, just staying with analysis for a bit. For the uninitiated, could you just help us understand what exactly is plaguing the US jobs market? I know it's not been the greatest time for the economy. The tariffs have continued to make headlines both in India and abroad and in the US, of course. But what exactly is that bugbear that's impacting employment rates and the jobs market in the US?
So first of all, the larger message is not that the U.S. economy is weakened or weak in any form. The economy is very, very strong, and I think you see that in the corporate results. The job market needed a bit of a cooling, right? Because look at this. The government was stimulating the economy with pretty low, close to zero interest rates till 2021 end. And then since last 3 years, 2.5 years, the government spending is immense. So U.S. government is spending about 7% of GDP. There is a deficit of 6.5 to 7% of GDP. At the scale when there is near full employment, even 4.2% unemployment rate is also full employment. It's considered full employment. So economy is strong. However, some of that, since the new administration assumed charge, there was a design to slow down the government spending and thereby the government jobs. So that bit of a cooling was anyways desirable. And when that happens, it also helps to bring down the inflation. So if you see the inflation data this time, there is a bit of a effect of goods inflation. So goods inflation grew by 0.4% month on month, whereas the typical number is 0.1% month on month, right? So that's a bit of a tariff bump, we can assume. But everybody believes that, I don't want to say transitory and jinx it, but it is one time and it is transitory. That's the assumption. But otherwise, job market, bit of a cooling off in the job market is more than welcome. And I think, don't look at the markets on a daily basis because that might be a position unwinding as there are long short positions every day, right? But otherwise, going by the numbers, economy is very, very strong. It needed a little bit of cooling down to bring the inflation back to 2%. And I think we are kind of getting there. But Federal Reserve, to my opinion, today's data proves that they might be actually behind the curve now. And it could have been better had they done the rate cut, in yesterday's meeting, Wednesday's meeting, Jude.
Right. Right, the economy is strong, but of course, jobs there, the big outlier. Anurag, thanks so much for joining us and putting things in perspective. Great to speak to you as always. With that, it's a wrap on this edition of Rush Hour. Thanks so much for joining us, but keep staying tuned to ET Now. Meanwhile, it's goodbye from us.